Every country in the world is in debt. The United States now carries more than $38 trillion, dollars, the highest level in its history. The European Union holds roughly $14 trillion. dollars. Japan is close to $9 trillion. dollars. Even oil-rich nations or export powerhouses like Germany and China are part of the same picture. All of them carry enormous burdens. And here a simple yet deeply unsettling question emerges. If everyone is in debt, who exactly is the creditor? This question sits at the core of financial history, where money, power, and politics collide. One truth must be accepted from the beginning. Nothing in this system is as simple as it appears. Debt is not merely a burden. It is the foundation of the modern world. Wars, crises, booms, and collapses all rest on an invisible framework of IOUs, unseen promises. Follow the chain of creditors long enough and a deeply uncomfortable truth appears. The world is not truly in debt to a single country, institution, or individual. The world is, in many ways, in debt to itself. But that does not mean everyone benefits equally from this structure. To understand how global debt surpassed $315 trillion, dollars, nearly 3 times the size of the global economy, we must go back in time. Long before digital money and credit cards, national debt was born not on Wall Street, but on the battlefield. In 1694, England was at war with France and running out of gold. The crown turned to merchants. In exchange for permanent interest payments guaranteed by future taxes, they financed the state. To manage this relationship, the Bank of England was created. It was a quiet revolution. The state could now spend money it did not yet have, while lenders received something priceless: a government promise that could be traded. Thus, government bonds were born. France followed. The Netherlands refined the system. The United States adopted it to finance its revolution and expansion. Debt stopped being a sign of weakness and became a measure of credibility. The ability to borrow became the ability to rule. Empires once conquered land to extract gold. Now they issue bataille to extract interest. The battlefield moved from territory to balance sheets. 3 centuries later, debt has become the world's largest product. Every country is a debtor. Every bank is a creditor. Every citizen, through taxes, savings, and pensions, is both borrower and lender. So who holds the other end of the rope? The United States provides the clearest example. Roughly half of its debt is held domestically by banks, pension funds, mutual funds, insurance companies, and the Federal Reserve. About $9 trillion dollars is held abroad, mainly by Japan, China, and European financial centers. So when people say America owes China, it is only a fraction of the truth. Most U.S. debt is owed to Americans themselves. Treasuries are issued, banks buy them, the central bank buys them back, creating new money. Taxes pay interest, and that interest flows into retirement accounts. The debt is real, but the creditor is often the system itself. This circular structure exists everywhere. Japan lends to the U.S. lends through the IMF, Europe lends through the World Bank. Developing nations send their reserves back into Western bonds. Debt moves in circles. Behind this system stand markets, hedge funds, pension funds, sovereign wealth funds, and central banks. They decide who borrows cheaply and who struggles to survive. When confidence vanishes, currencies collapse, governments fall, and economies are reshaped overnight. Democracy chooses leaders. Markets decide survival. At the center sit central banks. They do not merely manage debt, they create it. When they buy bonds, new money appears. One institution's liability becomes another's asset. That is why debt-free money does not exist. Every dollar reflects a debt somewhere else. This system survives on confidence until it doesn't. Greece, Argentina, and Sri Lanka showed what happens when belief breaks, and yet the system always restarts because modern debt is not designed to be repaid. It is designed to be rolled over. Old debt is replaced with new debt. Interest becomes the price of stability. Claims of eliminating debt are illusions. Debt is the heartbeat of capitalism. It flows through mortgages, pensions, and markets. The goal is not to destroy it, but to keep everyone believing in it. And one final truth remains. Saying we owe it to ourselves is only half true. Interest flows upward. Our debt is not just a transfer between nations, but between classes. Creditors and debtors are not heroes or villains. They are components of the same engine. The real danger comes when that engine runs out of fuel. At that moment, the question, who is the creditor, stops being theoretical. It becomes personal. And we realize there is no single face to blame. It is all of them and all of us.